Congratulations! You just graduated and you're off to Chicago to launch your career with that first big job. It's early June and you finished school last month. You'll be going up to Chicago soon to get settled into an apartment and start work July 1st. You really don't have any savings, but you do have a consolidated student loan that kicks in November 15. You have questions. Will your salary cover expenses? How much can you save? And a big reason you accepted this job offer was for the student loan repayment benefit. How does that impact your finances? Our free tool answers these questions. Let's jump in. First, a quick review of our jargon-free terminology. Money flows like water, and it needs a container. Think of this as what you own, what you owe, your ins, and your outs. Most of our money is stored in these four container types. When what you own is greater than what you owe, you have a positive net worth. And when your ins exceed your outs, you have positive cash flow. Our personal capital base expands when we save and invest, thanks to the paycheck we earn. We do spend money on expenses like insurance to protect our health, and we borrow money to finance things we aspire to own. Now let's add your data to the application. By now, you should have established a checking account with a bank or credit union. You may or may not have a taxable brokerage account, but when you start work, your employer will set up retirement savings accounts for pre-tax and after-tax savings buckets. When you create an account in the application, we make sure that these four financial account types are established by default. Let's initialize these accounts with nominal balances, just a penny in each, and associated rates of returns. Here's how we edit the fourth account. Note that we assigned 1% and 5% respectively to your checking and investment accounts. The other types of accounts we own are non-financial, like real estate and property. You're headed to Chicago soon and will be going on a shopping spree to set up the apartment before starting work. You specifically add 3 personal property accounts for furniture, clothing, and a bike to get around the new neighborhood. In total, you plan to spend about $3,000 on all 3 item categories. Unlike financial accounts over time, these types of personal property typically depreciate over time, so in the rate field, you assign negative 5%. To keep things simple, let's assume your financial life starts on July 1st along with your job. You enter that as the start date for these items. Since you plan on keeping these items a long time, you keep the end date fields blank. Lastly, you take ownership once on all 3. So you ensure that this is set on the frequency field. In your My Financial Summary page, we see the 3 new accounts are added. Under the My Reports tab and the Own sub-tab, we see our 3 non-financial assets are projected out into future years. These are December 31st values. Note that the values depreciate as we configured. Now let's add the O data elements to your financial plan. Specifically, the student loan starting in November, along with the credit card balance you'll be carrying that financed your shopping spree. Here are the terms of the consolidated student loan. Although it's currently outstanding, we establish its start date as November 15th to coincide with the legal start of the repayment period. The household debt section is where we add our O data elements. The application classifies debts as either good or bad. Education debt is deemed good because you should receive a return on that investment. Credit card debt or consumption debt is deemed to be bad because you aren't receiving appreciating returns. Rather than manage over a dozen student loan tranches, you've refinanced and consolidated into one loan at a 6% interest rate over a 20-year term. Our application's loan calculator confirms your monthly payment and term. Credit card debt is expensive. The bank or credit union associated with your card has an 18% interest rate on balances when charges are not paid off in full. There is no term to a loan off your credit card, but for now, you define a 2-year term and our calculator shows the resulting monthly payment. The 2 O account data entries are now in your My Financial Summary. In the My Reports tab and the O sub-tab, we see the amortizing loans in future years, with the student loan paid off in the year 2042 as defined. Now you address your in data account entries, namely your paycheck and the loan proceeds off your credit card. Before your paycheck hits your checking account, however, taxes are withheld from your employer and our application automatically calculates these outs for you. On the My Financial Summary page, you scroll down to the Inflows section to add accounts. Our salary is deemed earned or active income by the IRS and will be taxed accordingly. The loan proceeds from your credit card issuing bank, however, is not taxed. Your starting salary is $65,000 per year. For now, let's just assume that you receive 3% raises until your retirement age. Since you were born in the year 2000, that's conveniently the year 2065. The inflow from the credit card loan proceeds is $3,000. This is a one-time event and is not growing over time. One-time inflow or outflow events like this have start and end dates that match. Two in-account data entries are now in your My Financial Summary. In the My Reports tab and the In sub-tab, note that your salary is projected out into the future at 3% growth, while the credit card loan is a one-time inflow in the current year. On the Income Tax sub-tab report, click on the Federal Tax column to see the IRS's marginal tax system at work. At your income level, the first three tax brackets apply. Clicking on the State Tax column shows the flat taxes withheld by the state of Illinois. Lastly, your employer will withhold from your paycheck FICA taxes, which are for Social Security and Medicare. After these automated income tax outs, let's now address your liability payments. Scroll down the My Financial Summary to the Outflows section to add these items. Your student loan payment is under Education, while your credit card payment is under Consumption. The student loan payment of $214.93 is fixed and is not growing over time. You make these payments over the 20-year term. Similarly, the credit card payment of $149.77 is not growing over time, and you define making these payments over a 2-year term. Under My Reports and the Outs subtab, we see the two liability payments with the student loan payment stream terminating in the year 2042 as defined. Now we'll address the next set of outs, your healthcare insurance premiums. Once again, scroll down My Financial Summary to the Outflows section to add more accounts. Your health is worth protecting, and you take advantage of your employer's group insurance rates, specifically for medical and dental coverage. Medical insurance premiums have outpaced standard 2% inflation rates for some time now, so you assign a 4% growth rate. You leave the end date field blank because you know you'll be paying this insurance for the rest of your life. Dental insurance, however, has not been skyrocketing in costs of late, so you assign a 2% growth rate in these insurance premiums. Once again, on the My Financial Summary, we see that our two insurance premium outflows are accounted for. And under the Outs subtab within My Reports, the medical and dental premiums are projected out to perpetuity. Now we turn our attention to long-term savings. This is your employer's retirement savings plan. It's critically important that you pay yourself first. Your employer has a standard retirement benefit where they will match 50% of what you contribute, up to 6% of your salary. This is free money that you cannot pass up. To configure this, go to My Profile and then edit the My Financial Information section. Scroll down to where we enter these three parameters. Let's assume you'll put all your savings into the pre-tax account. First, enter the 50% employer match and then the 6% employer contribution. To receive the full employer match, you need to contribute at least 6% of your salary. Now, under My Reports and the Retirement Contributions subtab, notice that all your contributions are in the traditional pre-tax account and your employer match is half of these totals. Lastly, what about all your other living expenses? There's so much to consider and factor in. Oh boy, this can add up. How far can we stretch your paycheck to cover other needs and wants? Scroll down the My Financial Summary to see what you've entered as your best estimates. The apartment is $1,500 a month, along with several utility payments. You budget for more home decor, transportation to and from work, and around town for fun. You go out with friends to bars and restaurants. Notice that you assign different frequencies to these outflows and a 2% growth rate. Donations to your school and favorite charity. Vacation expense. Personal care, entertainment, big box membership fee, various shopping, and don't forget the annual credit card fee. The application does the math behind the scenes to annualize all your expenses. You can drill down into the cascading reports to check your entries. Within your checking account, we want to build and maintain an emergency cash reserve for those rainy days. Any excess funds can be swept into your brokerage account. Go back to My Profile and once again edit the My Financial Information section. In the Max Cash Reserve field, you enter $1,000 to represent your desired emergency fund. Under My Reports, let's examine the Asset Balances subtab. Here, we see that we do build up to the desired $1,000 cash reserve by the end of the current year, but no excess funds are arriving in your brokerage account. There's clearly a cash flow problem, because the only savings you're creating is just what's in your retirement accounts. Let's investigate why we seem to be running cash deficits. Under My Reports, go over to the Cash Flow subtab. It's clear that, aside from the current year, our total inflows are less than our total outflows each year thereafter. You project to have negative cash flow each year after the current year. What's missing from your financial plan is your employer's student loan repayment benefit. They will match your payment dollar for dollar. It saves you significant time and money. Our application's powerful loan calculator factors in prepayments, whether they are constant or lump sum. Let's go back to My Financial Summary and edit the student loan. In the constant additional principal field, enter the employer repayment benefit and notice total payment drives the loan's term down to 7 years and 3 months, ending on February 15th, 2030. Now that we've adjusted our student loan O entry, let's go back and add the employer repayment benefit as an additional IN entry. This inflow is essentially a gift from your employer that is not taxed. This company match inflow doubles up on your payment, and like your payment, it is fixed and not growing. You define the end date to be February 15, 2030 to coincide with the new loan payoff date. Here's the new inflow entry on My Financial Summary. And now we want to adjust our original student loan payment outflow. You edit that entry to adjust the end date to the new projected loan payoff of February 15, 2030. Let's review the adjustments we've made in My Reports. First, go to the O subtab and verify that the student loan is paid off in the year 2030. Then go to the IN subtab to see that the employer student loan repayment benefit is also reflected. Now let's go back to that cash flow subtab and see if we have positive cash flows. Inflows are exceeding outflows aside from the first full year, and it looks like you'll be able to pay off that $3,000 credit card balance in the current year. You can do this. Building healthy financial habits now sets you up to reach your goals. Master your finances and have fun. Thanks for jumping in.